Well, throughout this week, the focus has very much been on the UK for global financial markets, with obviously the vote taking place overnight our time to decide whether the UK will remain within the European Union or not. But in the meantime, we have had a number of other developments this week, which have been, I guess, more of a monetary policy focus, with the RBA minutes being released and also Chair Yellen speaking to Congress in the US. And to start with the RBA minutes, there wasn't really a whole lot of new information that was provided in the minutes from the RBA. They continued to note that the global backdrop was relatively soft, as had been expected, and there was some significant uncertainties there. But they have been relatively happy with what we've been happening domestically. So they noted that GDP in Q1 had ended up being about 0.5 percentage points stronger than had been expected, and the domestic demand data had been stronger, sort of both in terms of that outcome as well as also what we've seen in recent months for the partial data as well. So that gave them optimism in terms of the outlook, in terms of expecting non-mining activity to continue to strengthen, more so the consumer rather than non-mining business investment. But there was still hope that over time that non-mining business investment would come through as well. So we started to see momentum come through in terms of service exports and sort of other sort of little areas of the economy outside of the mining industry. Sort of the other key area to note from the minutes was around inflation and also sort of wages outcomes. We saw a bit of a discussion around unit labour costs in the terms of trade. The idea basically being that sort of the weakness we have seen in unit labour costs in the recent past has helped to offset the impact of the terms of trade decline. So basically helping us to sort of, along with the Australian dollar, helping us to sort of improve our competitiveness and actually gain advantage that way, as we lost it from the retail side and lost that income come through. And that sort of also, I guess, has sort of inflation expectation or inflation implications, with obviously softer wages coming through and therefore leading to weaker inflation outcomes. And that's sort of part of their thinking behind sort of what's been leading towards the weak inflation outcomes we have had in the recent past. The additional information they sort of talked about on the inflation front was to note that inflation expectations had moved down, and that is a potential worry given they sort of are looking to try and get inflation back towards that target. And based on their most recent forecast from the May Statement of Monetary Policy, that is likely to be a relatively sort of hard sort of target to reach, with their expectation being that we're unlikely to see inflation sort of move well into the target band within the next year or so. It'll likely take sort of 2 to 3 years to actually see that come through. So that's kind of really emphasising they still remain on watch and are willing to do more in terms of the policy front as it's needed, but they're also sort of being cautious and sort of optimistic around the activity front, and hoping basically that you'll see that stronger activity and momentum come through, and that will actually lead to an improvement in inflation outcomes and therefore a more limited need to act on the policy front. We continue to still believe they will cut in August after the next CPI, but then after that will likely remain on hold at 1.5% for the cash rate. We switch across to the US. We saw Chair Yellen, as I mentioned, speak to Congress this week. She spoke to the Senate one night and then also the House committee the following night. We saw there was, I guess, again, a fairly similar themes, being relatively optimistic about sort of the labour market outcomes after the last couple of week prints we have seen. As the consumer has bounced back in sort of April and May, there is expectation that jobs will also improve, and we have seen an improvement in initial jobless claims and also a continued strength in terms of the jobs data. So that does provide some sort of, I guess, support for that thesis, and they're really relying on that to come through and provide the momentum to the economy. That's really what's driving those trend growth outcomes that they are expecting, and really giving them the base to actually say, or to assert a need to raise rates from here on the back of that. So that's kind of their main focus at the moment, and they're waiting to assess conditions as the next couple of months to hopefully then think about raising rates come September, or if not then potentially later in the year. I guess their main sort of area of concern that was raised in terms of her testimony was around sort of investment, whether that's not necessarily a short-term phenomena, which is what they've generally sort of expected, but rather some more of a longer-term issue with productivity, which is meaning that businesses aren't really willing to actually go out and invest and expand capacity. If that is the case, then that is a downside risk to their growth forecast and potentially would curtail their ability to actually raise rates for the economy, and would likely see a much lower level, I guess, of a terminal endpoint for this cycle than they currently expect. At the moment, they're looking for a 3% sort of longer run terminal rate. Our expectation is closer to 1%. So that really emphasises a great deal of, I guess, volatility and uncertainty around the term interest rate expectations for the US. And it's going to take a number of months, if not years, to really assess how that economy is going to develop over time and what level of rates are important. Now, as I mentioned at the top of this piece, we are awaiting, I guess, the results from the UK. It's likely to be later this afternoon when we will start to get a more concrete assessment of the vote and whether the UK will remain in the European Union or not. The markets generally this week have been very much of the view that the Remain camp will win, and we will likely see, I guess, have seen quite a lot of positive momentum both in currency markets and also in equities. And so it'll be interesting to see how this all plays out and whether we are likely to see sort of further implications, I guess, for markets from here. It is likely to be a close result, so there is probably likely to be sort of further discussions in the coming sort of months and years ahead as to whether sort of there is a potential, what will be the final result, I guess, in this matter. So although we will see the vote today, it's likely to have further discussions about this, and both for the UK and also for a number of countries in Europe over the coming months and years ahead. We'll see you next week.